We are here to work problem P11-27A from page 611 in our book. So this is just a set of journal entries. So these are just different kinds of payables. We've got some note payable, we've got some warranty payable, just a variety of different things you might do, just different liabilities. So let's get started. We need a journal. I already kind of have one written up. All right, date, accounts, debit, credit. So the first one that occurs is purchased computer equipment at a cost of $12,000, signing a 6-month 9% note payable. So that's a current liability, that note payable. And we got computer equipment asset, $12,000. All right, so that's pretty straightforward. Right, computer equipment. I mean, you knew how to do this back in like chapter 2. Computer equipment, $12,000. Note payable, $12,000. All right, so nothing new about that at all. Of course, when we calculate interest, we'll need that 9%, but at this time, we don't really need that, right? Next, okay, here's a sale. Recorded the week's sales of $63,000. 3/4 on credit, 1/4 for cash, right? Sales amounts are subject to 6% sales tax, so we have to calculate that. It says to ignore cost of goods sold, but let's just pretend like cost of goods sold are $30,000. You know, I don't want to like forget how to do a sale. But this adds a little twist on what we're used to, right? We're used to a sales either cash, right? So you cash, sales revenue, right? Or it's on account, right? So we do account receivable, sales revenue. Well, in this case, it's both. We're just recording all of it for the week. So we kind of have to break it out. Obviously on a test I would just tell you how much was on account and how much was cash, but so 3/4 is credit, so 75% of 63, right, is what we're looking for, and then 1/3. All right, so we're gonna get cash in, right? We're gonna get an bunch of account receivable, right? We're gonna have sales revenue, and we're gonna have that sales tax payable. All right. Then the next part we'll have cost of goods sold, and we'll have, of course, merchandise inventory. All right. So how much of each? Well, 1/4 of 63,000 plus the 6% sales tax, that's how much we're getting in cash. So that's 63,000 times 0.25 plus whatever that is. It's 15,750 times 0.06 for the sales tax. So 63,000 times a quarter is 15,750, and then plus that 6% is equal to 16,695. All right, so how much accounts receivable? Well, again, those are 3/4 of 63,000 times 0.75 plus whatever that turns out to be. 63,000 times 0.75 is 47,250. Or I guess I could have just taken 63,000 minus 15,750 times 0.06, then that's equal to 50,085. Okay, so in cash we got 16,695. On accounts receivable we got 50,085. Of that, my sales revenue is 63,000, right? That's how much I sold, right? And then the difference between these and 63,000 is 3780. Alright, and that's my sales tax payable. Cost of goods sold, what did I say it was? 30? Oh yeah, I told you it was 30. So cost of goods sold is 30,000, and merchandise inventory 30,000. Alright, so there we have a sale. And the difference between what you've been doing in the past is we've added this element of sales tax that we collect and then send to the state in the future. So that's why it's payable. We're going to pay the taxes later. We collect it from the customer and forward it to the state. Alright, so on February, sent last week's sales tax to the state. Okay, so here's where we take this $37.80 and we no longer owe it, right? So obviously decreasing a liability is a debit. So sales tax payable $37.80, and of course you pay for stuff with cash. $37.80. Let's see here. On July 9, paid the 6-month 9% note plus interest at maturity. So here you go, right? Remember on January we got that. Now it's been 6 months, right? So we're going to decrease this note payable, right? So that's my debit. Of course, we have the interest expense, right? It's not payable because, well, we're just going to pay it, right? So, and then of course we pay for stuff with cash, right? So the note payable is $12,000. How much is cash? Well, we need to calculate interest, right? So that's my $12,000 times, what is it, 9%? Times 6/12, right? 6 months. Principal times rate times time, that hasn't changed at all. And that's equal to 540. So that means this is 12,540. Alright, the next thing. Let's see. Purchase merchandise inventory for $9,000, signing a 6-month 10% note. The company uses perpetual inventory system, so that means we need to put it on the books, right? So merchandise we buy came in, and we're going to pay a note payable in the future. And how much did we buy it for? $9,000. Alright, so there's our inventory on the books. What is next? Oh, end of the month. End of the year, I should say. Accrued warranty expense estimated at 4% of sales of $609,000. Okay, so warranty expense, we've got to estimate that. And then we'll have warranties payable in the future. People will say, hey, this thing broke, I want to return it. And so we'll use that warranty payable account as our liability. Warranty expense and warranty payable. So that, what did they say? 4%, 0.04 times 609, and of course that 609 is just what they tell me. That was our total sales for the year. We estimate 4% will get returned. Right, so 4% of that is equal to 24,360. All right, there we go. Excellent. All right, so there's our warrant. There's a liability, warranty payable. Next, accrued interest on all outstanding notes payable. Well, we just have one, right? I guess they're trying to catch you and see if you think you owe interest still on that 12 one, but we paid it off. So we owe, let's see here. So from this one on August 31st. So August doesn't count as a month. So September, October, November, December. So that's 4 months, 4/12. Because this was the last day, so it doesn't really count. So September, October, November, December, 4 months. And it's 10%, right? And the principal is 9. So we're going to have interest expense and interest payable. Right? This is an adjusting entry. We actually kind of already know how to do this. So what did I say that was? It's 9,000 principal times the rate, which is 0.10, 10%, times 4/12, right? And that is equal to 300, right? All right. Yeah, that makes a lot of sense. 10% of 9,000 would be 900, and 1/3 of that would be 300. Yeah. All right. And so that means interest payable is 300. All right. So there you go. That's our end. Then next year we come along and pay that note plus interest at maturity. So at this point, the note's only been around 4 months, so it's got 2 more months before we pay it, and so that means 2 more months of interest. And so when we pay it, right, when you pay a note, like here, right, you debit the note, right, so note payable. And of course you pay for stuff with cash. And we're gonna, oh, not that yet. All right, we're gonna, whoops, huh. Oh my goodness. All right, there you go, one for the blooper reels. All right, so we're gonna have that interest payable, right, because we accrued it here at this adjusting interest, so we're gonna pay it now. So we no longer have that interest payable. Then we're going to have 2 more months of interest expense. And we'll have to pay for all of this with cash. Alright, so the note payable we know is from when we got it, so that's 9,000. So we're going to pay all of that. Interest payable we calculated at 300. Right? Interest expense, well, that's the principal, 9,000 times the rate, 0.1, times 2/12. So that's equal to 150. Oh, well, I guess if this was 4 months, I could have just gone, oh, yeah, that's 150. I should have known that. And that's interest is always debit. And then cash is all of those added up. I guess this should be out here. 94.50. All right, so there's some sample journal entries. You might have to do any kind of journal entry, something like that, for your test.